Ladies and gentlemen, good day and welcome to the Q2 FY24 earnings conference call for Bandhan Bank. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vikas Mundra from Bandhan Bank. Thank you, and over to you, sir.
Thank you, Reo. Good afternoon, everyone, and a warm welcome to all the participants. It's our pleasure to welcome you all to discuss Bandhan Bank's business and financial performance for the quarter ending September 23. We will take this opportunity to update you on the recent developments in the industry as well as on Bandhan Bank during the quarter. To discuss all this in detail, we have with us our founder and managing director, Mr. Chandrasekhar Ghosh, Executive Director, Mr. Ratan Kumar Kesh, Chief Financial Officer, Mr. Sunil Samdani, Head Retail Banking, Mr. Shantanu Sen Gupta, myself, Vikas Mundra, Head of Investor Relations, along with other senior management team of the bank. We'll be happy to provide you with any clarity if required from the current quarter's number and the way forward. Now I would like to request our founder, MD and CEO, Mr. Chandrasekhar Ghosh, to brief you all about our bank's operational and financial performance along with the development for the quarter ending September 2023. Over to you, sir.
Thank you, Vikas. Namaskar. A warm welcome to all of you. I am pleased to state that the July to September 23 quarter has been an encouraging quarter for the bank. However, before talking about business number, I want to update you about one important milestone that the bank has achieved very recently. The bank earlier this month has successfully completed the migration into a new core banking system. We had faced some hiccups during the first few days, as one can expect in a mega transformation like this. But now we are fully functional. We are now live on Oracle's FlexQ, a CBS platform used by some of the largest banks in India and globally. This migration is the first step in our tech transformation journey. Along with the CBS, we have also launched our all-new internet banking platforms and M-Bandhan, our mobile banking app, both with far improved UX and UI and stronger functionalities. The new CBS, along with the surround system, will enable us to be far more agile, launch newer and more potent products and services, use data and analytics more effectively, and drive personalized customer experience. Coming to the business point of view, despite the various global uncertainties, India's key macro parameters remain strong. Inflation has softened to 5% to GDP in financial year 24, is projected to be around 6.5%. And the RBI has kept the repo rate unchanged for over 8 months. The favorable macro backdrop should continue to help the momentum in the Indian BFSI sector in the coming months. During quarter 2/24, Bandhan Bank's overall advances grown 12.3% year-on-year and 4.3% quarter-on-quarter. The quarter-on-quarter growth in the loan book reflects uptick in demand for all asset verticals. EEB vertical added about 6 lakhs new borrowers during quarter 2 financial year 24, as the EEB portfolio increased 5.2% quarter-on-quarter. The retail loan book grown 80% year-on-year and 15% quarter-on-quarter. Growth in the case of retail assets and commercial banking continues to be impressive. If you see that the commercial banking vertical consisting of financial institution group, MMG and SME lab grown 65% year-on-year and nearly 7% quarter-on-quarter. The housing finance book has registered a growth of nearly 4% year-on-year. In line with our medium-term strategic objectives, the share of secured asset as part of our total loan book continues to increase. It reached nearly 44% in Q2 24, up from 38% from 1 year before. We expect to have nearly 50% of our portfolio will be secured by financial year 26. Coming to this, the liabilities, which bank have a very strong presence on that. Sorry. On the liability side, total deposits at 1,12,000 crores at the end of September 23. It has been grown 12.8% year-on-year, a tad stronger than industry growth. As we focus on granular retail deposits, our total retail deposit and retail term deposit grown 13% and 20% year-on-year respectively. The retail to total deposit ratio, which was at around 71% in the last March 23, moved up 74% by September 23. CASA deposit, which stands at 43,196 crores at end of Q2 financial year 24, have shown an impressive growth of 10.5% quarter-on-quarter and about 6.6% year-on-year. CASA ratio stands at a healthy 38.5% compared to 36% in the previous quarter. Microfinance customers continue to contribute just about 4% of our total deposit. Customers continue to repose their trust in the bank. The bank has added about 10 lakhs customers in this quarter. Number of liability customers increased by 12.5% year-on-year. Volume of total customer transaction increased by 47% year-on-year. In terms of value, it increased by 13% year-on-year. Coming to this, the asset quality. Let us now move on to trend in collection and asset quality. There has been a good improvement in collection efficiency. The bank's overall collection efficiency, excluding NPA, stood at 98% for the month of September 23, up from 97% in the September 22. Especially for EEB segment, our collection efficiency, excluding NPA, stood at 98% for the month September 23, significantly up from about 95% a year ago. The post-COVID portfolio, consisting of all loans disbursed after June 22, clearly turning out to be a strong one. Gross NPA ratio of the post-COVID book stands at 2.6%. There has been improvement across buckets for both forward and backward flows. Current to SMA 0 flow was 1.5% in Q2 24 against the 2.8% 1 year ago. On the other hand, SMA 0 to current flows improved to nearly 25% in Q2 24 from 13% a year back. If we now like to see the profitability, the bank has registered a net profit of rupees 721 crores during the Q2 financial year 24 against a net profit of 209 crores a year ago. This was a year-on-year growth of nearly 245% in the profit. Our net interest income NII in Q2 financial year 24 was 2,443 crores compared to that of rupees 2,193 crores in the Q2 financial year 23, registering a growth 11.4% year-on-year. Our net interest margin stood at 7.2% in Q2 24, marginally better than 7% Q2 23. With faster portfolio expansion in Q3 and Q4, NIM usually move up. Just for the month of September, NIM was at 7.66%, reflecting festive demand. Gross NPA stood at 7.3% in Q2 24 as compared to 6.8% in Q1 24. Net NPA stood at 2.3% in Q2 24 versus 2.2% in Q1 24. However, total credit cost has been largely stable at 2.5% in Q2 financial year 24. The bank delivered an ROA of 1.9% and ROE of 14% in Q2 24. In the branch and digital expansion, the bank continues with emphasis on its branch network. This quarter, we have added about 880 branches, over 70% of which are in the northern, southern, and western zone. Today, the bank has its branch presence in 35 out of 36 states and union territory of the country. I also want to highlight how our performance in digital banking was improved. 95% of our total GB transactions are happening digitally. Monthly active users on our digital banking platform are up 57% year-on-year. Our digital transaction volume increased 47% year-on-year. Our UPI transaction increased 63% year-on-year. The bank has enabled direct tax collection under pay at the bank counter for customer as well as non-customer. We have also been authorized by the RBI for disbursement of central civil pension very recently. All this will help us offer better service to our customer and also to reach new customers. Overall, all these figures, I like to mention this, the 3 points. The growth of the business has come and showing this quarter is very good on that. EEB, we have been disbursed of 4,000 crores more than the last year same quarter. 4 lakhs new customer we are added this quarter on EEB. We are given the loan to them. Portfolio last year, the second quarter, there are 600 crores are declined from the first quarter, which is this year, second quarter, there are 2,000 crores increase from the first quarter. And all together, we have been seeing that a very good new and existing customers' credit demand has been increased. So that we are very confident on that. Credit growth has come up, and whatever we are guided our credit growth of this financial year will be reached on that nearly 20% year-on-year. Second, my point on that, the quality of the portfolio. We see that the quality of the portfolio, the DPD has come down. Total DPD SMA 0, 1, 2 in a EEB has come down 1.3% together in these three, and NPA increased 1.1%. So that is also, we have been seeing that the fresh slippage, recovery, and the DPD going down have been given the confidence we are returned back to this, the control of this, the portfolio. and which is the better portfolio we are gradually like to show in future. My third point on that is in deposit. Within these circumstances, the bank have been also grown their deposit a very good, and which have been given the confidence to us on that. We will be like to continue whatever the demand of the credit growth, deposit also will be not the challenge. Even not in a, if you see that my CASA have been increased from the last quarter 2.5% in this quarter within this situation. And my third point, all other parameters and ratio, it is all are aligned with the first quarter, more or less in the same on that all. It has been shown the confidence to the bank and the team that we are now coming to this better position, and we are from here to grow in a better way to the future. So of course, whatever the credit cost we are predicting in this financial year, 2% plus 20 basis point or minus, we will be like to reach, and that all parameters have been shown us. Finally, historically, the second half of the financial year is a significantly stronger period for most of our business verticals. As the festive season sets in, there has already been notable uptick in credit demand. Of late, we have successfully completed the migration into the new CBS and have initiated several steps to boost cross-sell and the branch-led sales to grow the retail assets and liabilities portfolio, and also to increase productivity per employee supported by our digital and analytical initiatives. Overall, we are all on our way of achieve long-term strategic goal of portfolio and geographically diversification. Before we end the session, I, on behalf of the whole bank family, wish you and your family a very happy Durga Puja and Dashara as well as Diwali. I wish you and your family all the best. Thank you. Enjoy the festival.
Yeah, Leo, we can start the question and answer session.
Sure. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mahrukh Adajania from Nuvama. Please go ahead.
Yeah, good afternoon, sir. So, my question is on the DPD of the DPD book of micro. Now, if you see last quarter's SME book, then this quarter's slippage is around 65% of that book, total SME. Now we are left with an SMA of around 17 billion. If you assume the same run rate of slippage, then would you again have a slippage of around 10-11 billion even in the next quarter, or will recoveries improve materially? How do you view it?
Manu, see, H2 historically, if you see, has always been a better quarter or better half for us for any financial year, whether it's in terms of new business growth or also the collection point of view. So the fact that our DPD has come down materially quarter on quarter, we expect this to reflect in the slippages number also going forward. And also, as I mentioned earlier, the recoveries will continue to improve. That has been the trend for last many years. H2, the recoveries are always better. So on both counts, we expect, one, the slippages to be lower and recoveries to be higher.
But is there any run rate of slippage for second half, percentage terms or any such things that, if at all, it's possible to guide?
So we don't want to put a number, but for that very reason, we've added 2 more blocks into our presentation. This is on page 7. Right? What we are saying is how our portfolio pre and post-COVID in terms of asset quality looks like, and also the vintage analysis. So from starting Q1 FY23, the disbursements and the portfolio performance accordingly. So if you look at both these blocks, it gives us the confidence that, the steady state credit cost guidance that we've been giving, this performance of last 1.5 years disbursements is in line with that.
Yeah, if I may add a little more to it. FY21 onwards, the portfolio is 92%. The GNP is 2.6%. And if I go even to 18 months portfolio, which is April 22 onwards, that is even better, 2.3%. So directionally, the DPD bucket is getting lesser and lesser. Also, the overall GNP is coming down for the newer set of portfolios. Therefore, we will continue to maintain that credit cost guidance of 2 ± 20 basis points.
Got it. And that should be achieved in 25 or in 24 end itself?
24 end itself.
Okay. Thank you so much.
Thank you.
Thank you. Before we take the next question, a reminder to participants that you may press star and 1 to join the question queue. The next question is from the line of Gaurav Kochar from Mirae Asset. Please go ahead.
Yeah, hi sir, good evening. A couple of questions. Firstly, if I look at the DPD movement and you have given the vintage analysis in that slide. So while you've given the NPA on disbursement, can you also call out what would be the DPD? I mean, I want to understand what would be the PAR book, because generally NPA would take 90 days. And even if I look at 4Q numbers, from there we are already starting to see NPA in second quarter itself. So just to give some context, do we have the DPD number 0 plus or maybe 30 plus early delinquency from that disbursement?
No, if you see that in the page number 6, so we have given that the DPD number 30 to 60 days. We have the DPD is a 1.1%, 61 to 90 days 1.3%. So that is there.
No, not that, sir. I am talking about the like you have mentioned NPA in the next slide. There's quarter by quarter. So let's say you've given Q4 23, the total disbursement was 21,000 crore. Of that, 120 crore turned NPA, and NPA as a percentage of disbursement is around 0.6. So rather than giving the NPA number, do you have a delinquency number, let's say 30 plus? How much?
That is not in hand now. It is not in hand now.
Okay. That would have been a little more helpful because NPA would obviously take 90 days, but delinquency would give you an early indicator as to whether the situation is worsening. Because if I go by this, then
only
1 year.
Only one point I mentioned in here. Overall, if you see that the 2.6% has come down 1.8%. 1.5% has come down 1.1%. This is together to all. Earlier portfolio, new portfolio. So major portfolio are new. If you say that 92% are new portfolio, that means that the 1.1% is majorly is 92% of the portfolio on that.
Sure, but sir, all of this has come down by moving them into NPA, not by recovery. So, I mean, at a aggregate level, the entire pool, if I add the 1 plus 30, 1 to 30, 31 to 60 and all of it, including NPA, the pool has only gone up by 300 odd crores. So it's not as if this pool is coming down because you're recovering money. It's more or less, there is a DPD movement. The 30 bucket is going to 60, 60 to 90 and 90 moving to NPA.
No, so Gaurav, if you add all, let's add the DPD as well as NPA. The total increase for the quarter is 260 crores, right? Yes. Which is well below our guided credit cost guidance, right? And
That is right, but ideally, because this is at an elevated level, one is expecting this to come down, not to go.
So that we discussed in the previous question, right? That we expect the slippages to come down and the recoveries to go up further in the H2.
Okay. Sure. And secondly, on the PCR, now you've given this contribution to NPA by vintage. If I look at the overall PCR, you're standing at around 70. Roughly 60-70% of your book is NPA book is 3/4 of your NPA book is MFI, and typically in MFI the recovery rates are much lower. So is there a case of increasing the PCR, moving it to maybe closer to 80%, where most of the banks are today, even without microfinance? So is there a case of because the recovery rates have clearly not been in line with the expectation?
So, as far as our PCR on the EEB book goes, we are at 85%. Right. The other businesses, the other second business, which is higher, in terms of NPA, is housing, where the coverage is about 35-36%. So, to your point, the coverage on the unsecured book is already at an elevated level of 85%. And also, if you look at our page 7, we have recovered. This is on page 8. During the quarter, we've recovered 246 crores from the ARC pool, which we had sold in the month of December 22 and March 23. And further, if you break that up, the December tranche, whatever was to be paid to the ARC and the investor, we have fulfilled their requirements, including the IRR. So now on, we are in a situation where every recovery from this pool will start flowing into the bank. So this is also an added, recovery which will start reflecting from Q2 onwards. As far as the March pool goes, which we sold to ARC, we expect to fulfill that requirement also by Q3. So the December one, we've already met the ARC and the investor requirement. March one, we expect it to be fulfilled by Q3. And in Q4, we will have both the tranche recovery reflecting into the bank's P&L. So the recovery is as strong as almost 246 crores per quarter. We expect the overall credit cost, if I have to adjust it with the credit cost, to be in our guided range, much below the guided range.
Okay, sir, just to understand this 246 crore, how does this get accounted? Because in the December column, as you mentioned, you already have, in the Q4 column, you already have NPA sale to ARC as 23 billion. Now this 246 crore is out of that ARC. So how does this get accounted? Is it part of the 400 crore recovery we are seeing in this quarter, or is this part of the P&L and netted from credit cost?
So two things. Firstly, the entire 246 crore is not something which has flown to the bank. It is only in the month of September that we've been able to fulfill their requirements. So only 1 month, effectively 1 month collection has flown to the bank. Right? So the full impact of that will be visible only in the third quarter. And that impact is about 93 crores, which is reflected as part of reversal of SR provisions. The SR book which we had kept as a bank, we had provided 100%. Now that we have started recovering, that book is coming down, and accordingly the provision is getting released, which is reflecting as part of my other income.
Okay, so you're saying out of this 246 crore, 93 crore was reversed in this quarter P&L. The remaining will be reversed in the next quarter.
So remaining has been
paid back to ARC, yes. And now their quota for December is fulfilled.
Okay. Okay, so this is out of this 23.2 billion which we sold in Q4, correct?
No, we are talking about Q3, the December pool. 8,900 odd crores.
Okay, because sale to ARC I cannot see anything in 3Q in your.
That was the combined written off pool which we had sold.
Okay, sure. Understood. Sure. So, let's say on a steady state, let's say next quarter onwards, assuming this is steady state, what could be the slippage run rate or credit cost run rate? Anything you can guide? Because last quarter also the slippage was X of the ECLGS book, the slippages were 8 billion. Now there is no ECLGS book, but slippage is still 13 billion. Just wanted to make some sense out of the next 2 quarters. How should we look at slippage? I understand the second half is typically better, but as far as the slippages are concerned, even in last year, the slippages were elevated in the second half. They were not lower. So, just wanted your thoughts around that, if you could help.
So, see, we don't want to put a number to it today, but, if you look at the DPD pool, that pool itself has substantially come down quarter on quarter. So, we expect the slippages also according to reflect that change.
All right, I'll probably take it offline. Thanks.
Yeah, thank you.
Thank you. The next question is from the line of Jay Mundra from ICICI Securities. Please go ahead.
Yeah, hi, good evening, sir. Thanks for the opportunity. Firstly, sir, on margins, right? So in your opening remarks, you mentioned that margins for the month of September was 7.6%, versus which is materially higher than what we have reported for the quarter. Is this a function of better yields, as you have mentioned, in terms of festive season, or you are seeing the cost of deposits or cost of funding easing off?
No, to correct your number, it is 7.3 and not 7.6.
No, September, only September.
For the month of September.
Only for the month of September. Sorry. Oh, okay. That was a mistake, yeah.
Okay, so 7.3 versus 7.2 for the quarter, right? So,
Yes.
Okay, sure. But anyway, so how are you looking at cost of funds, sir, incrementally? Should they remain firm up, or you think they have already, or are sort of peaking?
We feel that it will be 20 basis points or 25 basis points going up, and next the 2 quarters.
Yeah, but it will be compensated with higher yield, so we will remain in the range of 7 to 7.5 on the NIM side.
Sure. And secondly, on your AUM growth, right? So, YTD, financial year YTD, it is still a bit negative, right? That would mean a very steep ask for you to deliver the 20% YOY growth. Of course, there is a second half, wherein you see better business momentum, but you are confident of the 20% AUM growth, right?
We saw that there is normally second quarter always has been taken the time to balance with the March figure. So, if the last 2 years we have been seeing that it will be taken the third quarter also. So, whatever the second quarter in this year, we have been seeing that the business growth especially is coming from EEB, 2,000 crores given the extra, which has given very good indication on that the third quarter will be like to exceed the YTD. And the March it will become to this the nearly 20%.
Also, in March, we had mentioned that there is a very short-term loan against term deposit of 2,500 crores, right? Which is a very short-term and which has to be adjusted for the growth. So if you adjust that 2,500 crores, we are back to March level.
Right. Okay. Sure. And sir, on asset quality, if you can tell us the slippages from the EEB book, and so that will make slight more comparable on the SMA pool. Out of 1,320 crores of slippages, how much would be from EEB?
So the EEB is 1,000 crores, and that includes about 55 crores of Manipur.
Right. So, sir, if I net that off, so at the beginning of the quarter, we had SMA 0 plus 1 plus 2 of EEB at around 3,200 crores, out of which 1,000 slipped, and the ending pool is 2,800 crores, right? So there is still a reasonable inflow into SMA pool, right? That math is right?
1 minute.
Yeah. So the SMA 2 was about 700 crores, 720 crores, right? Last time, which this time is 690. And
Right.
SMA 2 plus the Manipur pool typically takes you to the slippages number. So Manipur is not there next quarter because whatever has to flow has flown. So which means proportionately we should see a reduction in the flow as well, and typically H2 is even better.
Right. Sorry, sir, and just to the last clarification, what was so special about Manipur? Sorry, just to refresh, was
55 crores.
No, Manipur is last 5 months is inactive, right? There is no movement happening there. There is a restriction there.
Right. Okay, sure. Okay, understood. Thanks. Thank you, sir.
Thank you. We'll move to the next question. Next question is from the line of Himanshu Taluja from Aditya Birla Mutual Fund. Please go ahead.
Hi. Hi, sir. Thanks for the opportunity. I just have a similar question what actually the last participant has asked. Sir, if I look at total last quarter DPD pool together is 2,800 crore of that DPD pool together, 1 to 30, 31 to 60 and 61 to 90 together. Now in this quarter that has actually come down to 2,300 crore. If I took last quarter 2,800 crore and 1,000 crore might be of the slippages, so your fresh flows from the standard book looks to be 500 to 600 crore, which gives me a sense on the total book between 3 to 4% of the incremental standard book is flowing in the past. So can you just give me a give me a sense why that the standard book is still that number looks to be elevated?
No, I didn't get your calculation. We will have to rework that calculation.
Sir, if I just like your 1 to 30 is 13.3 billion, your 31 to 60 is 7.5 billion, and your 61 to 90 7.2 billion of last quarter.
Correct.
Together is a sum of around 2,800 crore. Fair?
Correct. 2,800 crore. Correct.
Yeah. And in this quarter, your DPD pool, similar 1 to 90 together is 2,300 crore. Fair?
Yeah.
So from 2,800 crore, if 1,000 crore would have been slipped as an NPA, it means still 1,800 crore plus some your current book is 2,300 crore. It means 500 crore would have been come as a fresh flow from the standard pool, and that still remains 3 to 4% of your book basically, which is flowing in the DPD movement. So just trying to get a sense.
3 to 4%.
What is the why that fresh flows still remains high?
No, if you see that the 900 crores, the slippage has come to the NPA. Correct?
1%.
No, so on a steady state basis, we still expect about 2.5% to be the flow, and then there would be a recovery from there, right? And which would bring us to that desired level of credit cost. And what we are talking here is the gross slippages.
Hello?
Yeah.
Okay, sir, I will take it offline.
Now, how you calculate this at 3%?
Yeah. Sir, ideally I'm just saying your last quarter, SMA was pool around 2,800 crore.
And then 2,300 now.
I'm assuming the gross slippages of 1,000 crore from this has been come from the 1 to 90 day pool. So if 1,000 crores got deducted, it means that last quarter pool would have been around 1,800 crore. And in this quarter, if I do that together, your reported numbers is around 2,300 crore. So I'm just trying to understand your fresh flows from the standard pool still comes to around 500 crore. And if I do analyze this, if I do this as an annualized number, so it means 3 to 4% of the book is coming as an, it's flowing as an SMA. So just trying to get your sense.
No, 500 and 53,900 overall book you are calculating.
No, but I'm a little confused as to why 3% overall is not a good number, because we say 98% should be the steady state collection efficiency one should expect. And collection efficiency 98 means there could be 1 or 2% part paying customer, which effectively means 3% credit cost or the gross flow into the portfolio. And then there will be recovery from that pool. So that's the guidance we are any which way giving.
And in our case, 96% are full pay paying, 3% partial paying customers.
Okay. Sure, sir. Sure. Thanks.
Yeah, thank you.
Thank you. Before we take the next question, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. The next question is from the line of Saurabh Kumar from JP Morgan. Please go ahead.
Sir, just 2 questions. One is your interest on advances, it's not gone up. So can you just also, because I thought there would be some repricing which would have happened in the microfinance book. So what's happening there? And second is again back to this forward flow question. So if you look at your entire 0 plus including NPA, that's gone up by about close to 300 crores for the quarter. That's 2.3% of the opening book. Is that a fair way to understand it?
Yeah, so to your first question, this growth for the quarter has been back-ended. Typically you see that seasonality in our business. So July and first half of August, we were still degrowing. And the book started stabilizing end of August and the growth came typically in the month of September. So the average for the quarter is lower than the first quarter, and that's precisely the reason why my interest income is lower this quarter vis-a-vis the previous quarter. But this benefit will flow into the coming quarters.
Okay. And for the interest expense also, because of this, that's mostly mixed change or?
No. So interest expense, as we mentioned, in this quarter we had taken an increase in saving bank rate, which gets transmitted almost immediately. The term deposit, if I have to reprice it basis the current rate that we are offering our entire book, we expect the cost of funds to go up by about 20 basis points, 20 to 25 basis points, assuming current rate prevails.
No, so my point is your interest expense is also gone up only 1%. Your borrowings plus deposits also
correct,
gone up by a similar amount. So there is no we would have expected higher cost of funds. That doesn't seem to have come through.
No, so in fact it's also the other way around, because the benefit of the low cost CASA came in only in the second half of the quarter.
Okay. And just on the forward flow question, sir?
I think we discussed that. We'll take that offline because we our point is very clear with the gross flow or the slippages.
300 as a percentage of opening book is 2.3. That's the way to understand it, the total gross flow?
Yes, I mean, that's a right way to understand.
Okay. Thank you.
Thank you. We move to the next question. The next question is from Pranav Gupta from Ionos Alpha Investment Managers. Please go ahead. Pranav Gupta, you may go ahead with the question. There seems to be no response from the line of Mr. Pranav Gupta. We'll move to the next question. The next question is from the line of Gao Zhizhuan from Schonfeld. Please go ahead.
Hey, sorry, my question is on. Thanks.
Thank you. We'll move to the next question. The next question is from the line of Prabal from Ambit. Please go ahead.
Yeah, hi. Thank you. Am I audible?
Yes.
So this quarter, we saw very good pickup in savings deposits for us. But as a trend, savings deposits have been quite volatile. So why is there a volatility and was there a one-off in our deposits this quarter?
No. See, there has not been any element of volatility in our book. In fact, every quarter we had explained where there has been a movement from saving to term deposit. We've seen 2 quarters where the term deposit rate was materially higher than the saving bank's rate. We saw the funds moving from saving to term deposits. As we've now increased the saving bank's rates as well, we see a stability in the saving bank deposits. So with increasing customer base, that deposit is also growing because there is no material outflow there. And that's the reason why we see the saving banks go up.
Okay, and there was no one-off, meaning some of the larger banks are getting accreted during the quarter? Okay.
Nothing.
So bulk went down.
And the second question is, so we had earlier said that we are looking to reduce share of group loans, group microfinance loans in the overall book. But again, this quarter we saw very sharp jump in group disbursements. So is there a change in strategy or this is just an opportunistic kind of disbursement since we are targeting a loan growth of 20%?
No. So we said the percentage-wise, the share of group loan will come down. So as our retail, commercial, other businesses is doing better in terms of growth, we are also increasing our EV. The idea was never to degrow the EV or a group loan book. The idea was that the other businesses will pick up faster so that our secured, unsecured balances make up. And which is the case which is happening. We see the secured businesses are having a faster growth.
So retail has grown 80%, commercial 65%. We continue to maintain 20% overall growth with 17% on the EV side.
Okay. Just last question on the expense side. So since we are looking to grow the commercial banking book and go into the higher ticket size in the microfinance as well, do you feel that the quality of employees, the kind of salary that they are getting currently, will also have to be raised? And so structurally now we are going to see higher salary per employee compared to what we had in the past, since now we are introducing these new products and new businesses?
That has already been happening over the last couple of years. We've been investing on retail and commercial. That will continue. And as you progress, even on the retail side, we will need to hire good quality talents, as well as on the commercial side. That's already happening. There is nothing new. It will continue to happen in that manner.
So meaning the OPEX to asset or cost to income will continue to stay high for us at least for next 2 to 3 years as we stabilize our franchise?
Not really.
Not really.
We guided for 3.5% OPEX to assets. H2 is the period where the growth in the balance sheet happens. So with the growth in balance sheet, I think 3.5% OPEX to assets will be met.
And more importantly, the bulk of the cost on the IT transformation and new branches that we have added, that has already been done. Incrementally, the IT transformation significant cost will come down. New branch addition, as we said, will be 100 to 120 per year. So even that will also taper down.
Understood. Thank you. All the best.
Thank you.
Thank you. The next question is from the line of Praful Kumar from Diamond Asia. Please go ahead.
Yeah, thanks for the opportunity, sir. Very good evening to all of you. The first question is there any communication from the RBI on the Assam refund that we had to get?
Assam refund, one tranche has already been paid. We received some 47 odd crores and we refunded back certain amount of money where the customer had already paid back.
Okay.
And that is for the lower ticket size of up to 25,000 tickets.
Okay.
It's not related to RBI though, it's from the directly Assam government.
Okay, but incrementally, any update? When the next tranche?
Yeah, as in when they announce the higher ticket size, we expect to get a higher share of the overall kitty.
All right. And then second observation and comment from Mr. Ghosh would be to understand more on the senior level exits that we have seen in the bank for the last 1 year. So broadly want to understand more, from a culture point of view, anything that we are doing incrementally to ensure that stability at the top level is maintained?
Yes. We are maintaining in that top level.
Okay, sir. All the best.
Thank you.
Thank you. Before we take the next question, a request to participants to please limit your questions to one per participant. The next question is from the line of Srijan Sinha from Future Generali India Life Insurance Company. Please go ahead.
Yeah, thank you, sir. So I wanted to understand what is the status of the CGSMU recovery that we were supposed to get earlier in Q1, then it got pushed into Q2, and we have still not got that. Where is it?
CGSMU, there was an audit done, considering there's a large amount. They initiated an audit. Audit has been completed. There are certain queries that have been raised. We are answering those queries. That resulted into some bit of a delay in the whole process. But we are engaging with them. As and when it comes, we'll keep you updated.
And that should hopefully happen in this quarter?
Because it's a government matter, we cannot put a date because that's wrong to commit anything. But yes, we are pretty much engaging and answering the queries. And yes, it has slightly delayed the whole process so far. But we are hopeful that it should come out at some point.
Okay. And sir, my second question is on savings bank interest rate hike that you have done. I missed, when was it implemented?
Sorry? Oh, this month.
When was the saving bank interest rate hike implemented?
Yeah, it was implemented last month. That's on a specific bucket.
In September month, you mean?
Yeah, that's right.
From September.
Okay. So my final question is on the asset quality. If I look at your collection efficiency, quarter on quarter that has gone up by let's say about 100 bits, excluding NPS. 98 has gone to 99. If the collection efficiency is at 98-99% consistently over last 6 odd months, what explains this forward flow into the NPA bucket?
So see, we've been telling this that our full paying customer, one should look at collection efficiency along with the full paying customer. That has been only 96%, which typically means at some point of time, 4% of the customers will slip into NPA. Since they are part paying, there will be recoveries also from those customers, and ultimately we'll recover some money from those. So that is where you see this 3.5-4% kind of a gross slippages number coming in, because the full paying customer is 96%.
Okay, fair enough, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Prakhar from Elara Capital. Please go ahead.
Yeah, hi sir. Thanks. 3 questions. First, in terms of CGSMU recovery, and you probably mentioned that you can't put a timeline to it, but this was always a government thing. So what made us change our stance in one quarter where we were so certain that it will get reflected in Q2, and now in this presentation when I look at, we have not even put out a date that is reflecting Q3 also. And what happened with CCLG's guarantee, wherein we also last time said that it will happen in Q2, but that seems to also get delayed.
So the only change occur is that in the first tranche for the 900 crore, there were no audit. In the second tranche, there is an audit happened. And given that audit has happened and there are certain queries raised, so we are answering all of those queries. That, according to us, has delayed the process. Otherwise, we are quite hopeful to get it. But yeah, audit also happened because the amount is more than 1,000 crore.
So now,
what is the amount?
No, amount is in higher. If you see that the 917 crores is the first tranche, second tranche we are applying for 12.90 crore. So when it has been exceeded in the 1,000 crores, so there isn't some process is there. It must be audit, and then we would be like to process on that. So that is the one cause as per our knowledge.
And ECLGS, as you know, it's a bit of a operational that upload issue, and it's happening on track. I think 85 crore is already done. 410 odd crore is still pending, and it will happen as per the process. Because there are no bulk upload facilities, so it has to be done.
ECLGS last time we discussed, right? That it has to be uploaded one by one. There is no bulk upload facility, and there are capacity constraints at the CGT-SME level. So we have uploaded and received 85 crores in the quarter. The total amount to be received is about 500 crores, of which 85 is received, 410 is something which is pending.
Okay. Just on second bit on liability side, you probably mentioned a bit about it, but on savings, when I look at average SA balance per customer, when I look at a comparison trend at industry level and you are reporting a 3,000 balance per customer rise in a quarter, what explains this?
No, so as we mentioned, we've increased our saving banks rate, and so it gives customer the flexibility to use the saving bank account at a maybe 1%, 1.5% lower than what they get in the time deposit. And if the customer wants to opt for that, they don't, they keep money in the saving bank instead of moving it to the term deposit. And that has helped us increase the overall balance. If you see in September 22, it was 59,000 crores. It came down to 51 because the gap between savings and the time deposit rates increased during this period, as time deposit rates went up by almost 200 basis points in last 1 year, and saving banks remain constant.
The quarter-on-quarter growth has come up. So you're talking about, last quarter we've grown from 51.
No, the only thought process that I had is that you raised rates in September. So probably our customer base is so sensitive to interest rates that we probably saw within a fortnight that our average balance is moving from 51,000 to 50,000.
That has also helped, and also the new customer base that we acquire. And, if you offer 6.5%, 6.75 as an interest rate, so clearly these customers, there isn't some bit of sensitivity towards the rate, right? We are a bank, since inception, we've been offering differential interest rates.
Yeah, I think just to add to what Sunil said, if you look at the individual customer segments, the overall balances have gone up. So that's something that we're seeing as a positive sign. Okay.
Just one last bit in terms of your other income. So this collection fees from ARC that you had of around 37 crores this quarter, given that for December tranche that you have already paid through, and March you are expecting that it will be paid through in next quarter. Till when we see this collection fees coming from ARC?
I think by Q3 we should stop receiving this collection fees. So Q3 would be end, and some part of that could flow in Q4. But after that, I don't think that collection fee would be applicable for us.
Got it. And 93 crores that we talked about is there in other fee income.
Yes.
Yeah, that's part of the other income.
So other income also has a 44 crore mark-to-market hit on account of bond yield going up, and this 93 crores as well.
Got it. Thanks. That is it from me. Thanks.
Thank you. The next question is from the line of Piran Engineer from CLSA. Please go ahead.
Yeah, hi. Thanks for taking my question. Just one thing on the housing book growth has been, slow for 3-4 quarters now. So any comments on that would be helpful.
Yeah, thank you for the question. We are, what we see in the housing book is that we are seeing a steady recovery. If you look at 2 or 3 things that we are seeing as green shoots. One, the fact that overall disbursements are going up. 2, we are seeing productivity of our businesses, especially across the country, is going up. We did, a change in platform, etc., and therefore the impact that we had initially foreseen, we have gone past that. So what we see right now is steady recovery. I personally foresee that over the next quarter, we see even stronger growth coming back because the underlying drivers of the business are looking reasonably strong now.
And just to put some number to it, the run rate has moved from 200 crore per month to 550 crore per month already. And from here on, as Shantanu said, Q3, Q4, we should see a significant growth uptick from here on.
Got it. Okay. And secondly, just in terms of your 3.5% expense ratio guidance, is that for FY25-24? If you could just remind us, please.
This is for FY24.
Okay, and then in 25, we expect that to go down.
10 basis points.
But we'll communicate that in Q4, Piran.
Okay. This is helpful. Okay, thank you all. Thanks.
Thank you. Before we take the next question, a reminder to participants to please limit your questions to 1 per participant. The next question is from the line of Param Subramanian from Nomura. Please go ahead.
Yeah, hi. Thanks for the opportunity. Just one question on if you could remind us the accounting for the CGFMU recovery, 1,600 crore, how it will flow through to the P&L? Will it just reflect as recoveries and upgrades with minimal impact to the P&L? Is that understanding correct?
No, so the entry will be the same as in when it comes, what was for 916 crores, which means this money has to be parked into a separate account as liability, and that account can be treated as part of the provision cover, which effectively means your net NPA comes down.
Okay, and your PCR moves higher. Without any direct impact to the P&L, say if it comes from Q3, it will not reflect in a direct impact in the P&L, right?
Yes.
Okay, that's it. Yeah, thanks.
Thank you.
Thank you. The next question is from the line of MB Mahesh from Kotak Securities. Please go ahead.
Hey, hi. Just one question. Are you able to do any form of analysis of the delinquent borrowers if they are able to get access to any other form of credit with other MFIs?
Sorry, couldn't get the question.
Very difficult to check that. I mean, historically, they have always been
whenever the
when we are finding out anyone from the credit bureau, automatically their credit score has come down. So they are not eligible to get the funding from us because we have been introduced the credit score for list the credit borrower.
So typically, most of the MFIs today do not give any loan for anybody who is defaulted in the other financial company. So anybody who is into NPA with us will not be given a loan outside, and similarly, we do not do that. This is a code of conduct which is signed by a SRO body. So to answer your question, no.
Okay. Because the problem has been that the delinquency that we see in your book is completely at odds to what we are seeing outside. So just trying to understand what explains a consistent divergence in performance that still exists today when every evidence suggests that on the ground things have improved. So where is the miss that we are consistently getting on being surprised on the asset quality numbers?
So we discussed this last time, right? As an organization, we have tightened our policy in terms of people eligible for the new loan. Whereas at the industry level, we see more of a business as usual and loosening requirement vis-a-vis the COVID times. So that could be one. And in an unsecured loan, just to give you an example, today our policy says if a customer becomes NPA and they repay the loan, we will wait for 90 days before we extend a new loan. And these 90 days we will track their CIBIL and see their track record outside Bandhan. So these kind of policies are not there outside. That could be one of the reasons. It's unless you have a detailed survey, very difficult to
Plus, if you would also look at DPD from 1 to 180 and then 180 plus as well. If you go into those two breakups, you may not find too much of a difference. You may find a difference between maybe from a 1 to 180 number. 180 plus would be pretty much aligned with all the other companies.
Sorry, just to clarify, Sunil, on this point, when the borrower knows that the risk of not getting a fresh disbursal is high for the next 90 days, and there is an availability of alternate channels of credits who have started to disburse loans, why do you think that borrower is not utilizing the facility and risks a no disbursement scenario for the next 90 days, or probably much higher till the time he repays his dues?
Will feel that way and will act accordingly. But ultimately, I have to bring that credit culture back. So what is required to do that? There has to be some tough decisions to be taken to bring back that credit culture.
Okay, sir. Thanks for this.
Thank you very much. That was the last question. I would now like to hand the conference back to the management team for closing comments.
I want to thank all the participants in this investor call for posing us the question and listening to us and giving us an opportunity to answer the question. We look forward to interacting with you more as we progress. And some of the queries that you posed, we probably could not furnish the specific numbers. We can take those offline because we'll be ready to sort of take this question and answer. And on behalf of our founder and CEO, Mr. Chandrasekhar Ghosh, the entire management team, I have the pleasure to wish you all the best for Durga Puja and the festive season. Thank you.
Thank you to all of you.
Thank you very much. On behalf of Bandhan Bank, that concludes this conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.